Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
What are we watching? We're watching Chinese exports. We're watching Chinese exports. We're watching Chinese exports. That'll tell us if something is happening good in China that will help China in this environment. We're not watching GDP. We're not watching the amount of stimulus. We're watching how much they're pumping in the infrastructure and increasing capacity. We're watching how much money the banks are spending, which we think is going to be a major banking problem in the future in China. But in terms of whether or not this scenario really plays out, China's exports have to rebound and their imports have to rebound in order to suggest that their domestic economy is picking up and they're buying stuff too. So this is the idea that the U.S. juices the globe again, gets back in that implicit weak dollar policy to drive up stock markets and build confidence in the consumer and allow them to spend again. And it's a very plausible scenario. And with the U.S. interest rates at 0.5%, 0.25%, guess what? The U.S. dollar then looks like a dollar carry trade or the dollar or the funding currency in the world. Remember, as I said, interest rates are a powerful driver. The relative difference in interest rate, short-term interest rates in the U.S. compared to Europe, Europe still has the edge. The euro has the edge. So everything else being equal, anemic growth in Europe, anemic growth in the U.S., and U.S. interest rates lower, people are going to tend to borrow the U.S. dollar as a funding currency. We could actually get into this idea because U.S. interest rates are so low of a dollar trade currency. Everybody used to talk about the yen carry trade currency, borrowing yen at 0.25%. Well, now you can borrow dollars pretty low now to fund what's going on around the world, and that may be part of this implicit policy to, again, use the dollar in a managed move lower. Problem is with managed moves lower, sometimes it's like herding cats. These things can get away from themselves. So this scenario could turn into a dollar disaster scenario. But this is a scenario of the U.S. muddling through slow growth, trying to stimulate the world. And it looks like that's what they're trying to do sometimes, especially given how much money they're putting in the market in terms of government bonds and quantitative easing. Stimulus hasn't worked. This is a muddle-through policy of the U.S. low growth, low interest rates, just getting along okay, no great risk. Credit markets still in play, pumping out around the world. The dollar continues to weaken, probably goes back into a major bear market. So the result of a muddle-through policy, we go back into a long-term bear market dollar trend. And in terms of what we're looking from a technical standpoint, again, as I said before, you're matching your technical analysis. Boy, did I mess this up. Technical analysis with your fundamentals. So you have that. Say we have that as our primary view. What I just showed you, the dollar muddling through, the dollar becoming the dollar carry trade currency. Here's your technical level, at least from our standpoint. We're looking at this first move labeled 1 here at 74.31. If nothing else changes in the global economy that we see above the surface or we can analyze and the dollar breaks down through there, guess what? Guess what becomes the number one view? Regardless of whether or not we understand anything that's going on, the dollar muddle through policy becomes our number one view, and we have to change positions. Needless to say, if the dollar goes from here to here, we've probably gotten out of a lot of positions in here, but this changes our mood in a big way and suggests maybe the dollar is in a major long-term bear market again. We don't think so, for a lot of other reasons that we just don't have too much time to go into. Again, if the dollar muddles through, China drives growth, China's export demand increases, guess what? Those commodity currencies are going to go a heck of a lot higher. So we'd be buying ISE puts on the Aussie, ISE puts on the Canadian dollar. Guess what also goes higher? The euro is going to go a lot higher because people are going to get into this idea and it's going to grab hold in a more real way. Hey, the world reserve currency, the dollar, U.S. is neglecting the dollar. They don't care. The euro as the dollar alternative currency at the moment will rally in a very, very big way, being the dollar mirror image. ISE puts on the euro. And again, intermediate term. if you start to see these views play out. I'd say 3 months at the shortest, 6 months would be about right. Emerging market currencies would continue to rally in a very, very big way if we get through the muddle through strategy. So here's some other information, and I apologize. I think I've rambled way too much on that. But again, it's not rocket science, but I think if you really step back and gain some perspective on the fundamentals, it will help your technicals, and it will give some sense to your technicals. So when you start looking at your technicals, you can start to layer some perspective on your technical analysis, and I think that's really very, very important, and it's why we use them. Information on the ISE FX options right here at fxoptions.com. If you haven't been there, it's a great site. Here's our homepage. Here's our email. If you have questions about today, I'd be happy to answer them. Currency Currents is our free daily global macro commentary, our view each day. Currency Strategist is our subscription-based letter, and we're starting to manage money now through Black Swan Capital Management, our currency program. If you contact, we can send a DDoC on that. So I'll get to try and answer some questions here. Lynette. First question is about liquidity in the ISE options. Steve could probably answer that better, but I would say that when we trade these options, we always try and enter with a limit price. When I say always try, if you're in a situation where you have to get out of something and it's breaking and going against you, you know, a market order you can throw in, we try and use a limit price to get into these. And I know some people say, well, if you use a limit price, you're going to miss some good trades. But we're of the view that a lot of good trades come by. We want to get in the price we want to get. So I would suggest if you're worried about liquidity and some of the spreads in here, and there's no doubt that is a problem in all currency options market, not just the ISE. Some of the options that aren't near the money, the most active options, there's not much liquidity, but you don't have to be afraid of that because ultimately they're tied to the underlying. No doubt supply and demand can drive these things in a bigger way than when there's no liquidity. But again, to get around that, use a limit order to enter and even a limit order to exit, and I think that'll allow you to get around those concerns. And I think you're going to see more and more liquidity come into this market as people catch on into how well they can be used in this type of strategy. And I also think so many people are being burned, to tell you the truth, in the FX spot market. They're being told, you know, open this FX spot account, put in $10,000, come trade with us and make $1 billion. People are being burned so badly in that market. I think they're going to step back and say, look, spot trading short term doesn't make sense for me as a regular retail investor, but this product does make sense for you. And from that standpoint, I think you're going to see more and more volume come into this market as people realize really how great a product like this is. So I don't think that will be much of a problem anytime soon. Question by Joel. The yen has recently moved, but where were the fundamentals for this move? It's a great question, Joel. We had really thought that the negative fundamentals were finally going to start feeding into the yen, and we were very, very wrong. The move lately has been a risk bid move into the yen. We had thought that most of the retail investor money that was offshore in the yen had come home, had already repatriated because the interest rates had fallen and it got riskier in some of the other asset markets, institutional and retail. But I think what we're seeing lately is this idea of some of the Asian money being very, very nervous about what's going on in China. And they don't necessarily like the dollar, and they're hiding in the yen on the risk bid. And as I said before, sometimes the money flow trumps the fundamentals. That fear move into the yen because of the risk is definitely trumping the fundamentals, because the fundamentals in Japan are absolutely awful. So it was a similar scenario in the dollar move in the credit crunch, even though the U.S. fundamentals were awful.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.